I'm Gary Regenstreif, Executive Editor with S&P Global Market Intelligence. Welcome, and thanks for joining me for this live conversation with Paul Gruenwald, the Global Chief Economist with S&P Global Ratings. We're coming to you following the latest forecast from Paul and his team. We'll dig into that and the outlook and risks ahead for the global economy. I'll start us off with a series of questions and leave time toward the back of this session to get your questions in too. You should be able to submit them now via the platforms you logged into. Today, we find ourselves in uncharted waters in modern times with contractions unseen in decades in many parts of the world. There have been profound shocks to workers, companies, and industries. There are also concerns about trade and uncertainty around the US elections. There seems to be less uncertainty, meanwhile, around some stock markets, which have defied gravity and some say may be out of sync with the economic fundamentals. Let's get into these now. But first, just a reminder of how deep the pandemic plunged the global economy. We'll see in this first slide that we've pulled up a kind of startling illustration of the economic fallout in a dozen important economies. Paul, after that massive shock in the second quarter, it looks like activity from July through September rebounded strongly. Your new outlook for global GDP overall remains unchanged for the year from the last forecast just a few short months ago. But there's some important nuance there. Let's call up the new forecast that we have. And if you can, we're going to get into some of the specifics around particular geographies like the US in a second. But can you, Paul, broadly speaking, talk to us around the globe for the audience looking in? What are the regions or countries that are showing signs of performing better and which are poised to fare more poorly?
Okay, well, first, hi, Gary, and thanks to S&P Global Market Intelligence for inviting me on today. As you said, we just released our Q3 global forecasts, and although the headline growth number globally at -4% didn't change very much from the previous quarter, there are a couple of interesting and important stories right under the surface. And let's start out with the economies that are doing a bit better. We would certainly put the big three regions in that list, the US, the Eurozone, and China, for slightly different reasons. In the US and Europe, we are seeing the household sector pick up. Households were originally quite conservative and saving a lot, but Q3 has taken us back to the level of retail sales we saw at the end of last year, and household spending seems to be ramping up. So those are consumer-led recoveries. China's a bit of the opposite. We've seen a strong recovery there, and we've raised our forecast by a full percentage point. But it's really the old playbook. It's the state banks lending to the state enterprises, big infrastructure push. The household sector and service employment in China remains relatively weak. So we would characterize their recovery as not yet sustainable. We'd want to see a bit more organic growth and a bit less state-led growth into next year. And then the countries we've marked down, India, again, quite a sad story there. We've got -9% growth now in the current fiscal year, which is April to March of 2021. That by itself drives the global number down by about 40 basis points. And then we've also marked down the UK and Japan. So as you said, there's a bit of variation there right under the surface at the country level. But overall, we're still at about -4% for global GDP growth this year.
Okay, well, let's dig into the weeds of some of these and start out by focusing on the US, where you're forecasting full year GDP to contract 4%, which is better than the 5% forecast previously. But am I wrong, or there are some troubling indicators? The US has replaced half of the 22 million jobs lost in March and April. But on Friday, we saw the third month of slowing job growth in the US. And there was also a drop in household income at the end of the summer and smaller gains in consumer spending. So the question is, after the third quarter boost, are we now entering a long slog back to recovery in the US?
Right. We think that's probably the correct way to characterize it. First off, we should probably pay less attention to growth rates. I know everyone focuses on the growth rates, and we just talked about those, but the US was minus 33 annualized in the second quarter. That's the quarterly number stretched out for a whole year. And we'll probably get something close to that with a positive sign in Q3. So these are so far outside of the normal distribution of outcomes that we're basically telling our clients and stakeholders and everyone else who will listen to just put the growth rates to the side for about a year and focus on levels. And Gary, you mentioned the levels there, and that's where we're focusing now. The US and most major economies are still 10+% below the end 2019 level. And we're watching the labor market very closely, both in the US and Europe. The US has taken the approach to COVID to let unemployment rise and then send fiscal transfers to the households to cushion the blow. But as you mentioned, we've only regained about half the jobs in the US. A lot of that was sort of a mechanical rebound from the very steep drop in April and May, but we're down to 7.9 unemployment in the US, and it's going to continue to improve slowly, but it's really going to be the key for the next couple of quarters is going to be fiscal policy to keep the viable firms and the workers together, and to keep the sort of the connective tissue between workers and firms in place, so that when we get a vaccine and a recovery, that can happen faster. But we will see a big bounce in Q3, but then much more modest and eventually normal looking growth after that.
Right. Probably need to provide some caveats to that unemployment figure and those who look to it for signs of recovery. There were a fair number of people who left the job market, which helped bring that down, didn't it?
Yeah, I mean, the headline unemployment rate should also always be taken with a grain of salt. As you know, the Bureau of Labor Statistics puts out, I guess, half a dozen different unemployment rates. There's another one called the U6, which looks at discouraged workers or part-time workers, and that's still in the teens. And then people who leave the labor force aren't even captured. Maybe a better way to look at that is a lesser known statistic called work done, and that's just showing the amount of one unit of work and how much of that's getting done over time. And the U.S. and Europe are actually pretty similar on that one, but that shows a pretty steep drop. And again, we're running well below potential. It's going to take years, not quarters, to get back to where we were with a 3.5% unemployment rate, which is where we were when all of this COVID stuff started.
Right. You mentioned stimulus a moment ago. While the U.S. Fed has been, or appears to have been, rather aggressive in providing monetary stimulus, the fiscal stimulus is running out, and in some instances of it has expired. The Fed chairman came out as late as yesterday, once again, to press for more federal aid, which seemed to echo the kind of global call from the IMF yesterday or the day before as well. President Trump yesterday suspended stimulus talks in Congress until after the election, and then tweeted last night that he was open to some additional aid. How important is a fresh injection of that fiscal stimulus to either households or businesses, and what are the risks of delay?
Well, we think the fiscal policy response is key. Chairman Powell has been talking about this in the last couple of days, couple of weeks, but monetary policy's done about as much as it can. I mean, there's a couple of things there. One is to make sure the markets are functioning smoothly. So we saw the Fed intervene in money markets, commercial paper markets, swap markets, even some of the credit markets. But that was just to ensure orderly trading. And then we've got quantitative easing as well. But the heavy lifting for the policy response to COVID is going to have to come from Fiscal, whether those are transfers to firms to incentivize them to keep workers on the payroll, or direct transfers to the households themselves to help cushion the blow, or some combination of that. That's going to have to bridge us. It's going to cushion the blow and then bridge us to the eventual recovery. And again, to use that connective tissue analogy, we don't want a bunch of viable firms to go out of business, and we don't want workers to get separated from their firms, because that's all going to have to be reconstituted and rebuilt. And the uncertainty doesn't help. We've seen some of the European countries. Germany, for example, has extended some of their part-time work schemes into the entirety of 2021. So it's the fiscal response that counts, and also the certainty that it's going to be a predictable response. And we think that's the best way to bridge to a sustainable recovery.
The German case is an interesting one. I'd like to circle back a bit later to compare the kind of international responses. But staying with the U.S. for a moment, your colleagues in ratings came out with a report this week saying that ratings downgrades to creditworthiness at companies slowed, but the negative outlooks are at unprecedented highs, indicating more ratings actions ahead. I'd like to pull up a slide for a second around bankruptcies. Our news team pulled this tally of corporate bankruptcies in the US, which continues to climb unabated. A total of 509 companies have gone bankrupt this year as of October the 4th, which exceeds the number of bankruptcy filings during any comparable period since 2010. I should say this chart is indicative rather than inclusive. It doesn't cover all companies, only those public or private companies with public debt, and public companies included in the list with public debt must have at least 2 million in either assets or liabilities, and private companies at least 10 million. All of which goes to say this surely excludes a swath of troubled small businesses. So the question to you after this discussion of stimulus and the state that the economy is in, how do you assess the risk of additional corporate distress and indeed defaults?
Well, that's one of the main areas of discussion the economists at S&P Ratings have with our credit colleagues. There's a team led by my colleague, Alexandra Dmitrievich, who produced this particular chart. But yeah, the macro background that we've been discussing is what it is. And then the question is, how does that flow into the credit world? What sort of impact does it have on bankruptcies, on defaults? There was another credit document released yesterday in parallel with the macro document, which is talking about a doubling of defaults in both the US and Europe. So yeah, I mean, that story is parallel to this one. It's just seen from a credit angle rather than a macro angle. But I think our credit colleagues definitely agree with us that the risks are still on the downside, and just like a GDP number, these credit events and the bankruptcy events happen with a lag. So to the extent that we continue to struggle in the recovery, we would continue to see pressure on some of these credit metrics as well.
Right. The weakness, just looking at some of the sectors, the weaknesses of some of them due to lower demand have been well known and documented, including consumer discretionary, travel, energy. Given the slowing in the hiring we've seen, and tweaks to some of the growth forecasts, I mean, what's the outlook for these and our other industries at risk of softening further?
Right. The sectoral impact is actually something we've been looking at quite closely. Again, we haven't had a global pandemic in almost a century, so we weren't really prepared to put the lens on the sectors. But I think we know now pretty clearly which ones get hit. Anything that gets impacted by social distancing, whether that's food and beverage or airlines or entertainment or cruises or anything with sporting events, anything with person-to-person contact is getting an outside hit. while other industries such as tech and healthcare, parts of financial services, home improvement seem to be doing well. So we've got different buckets that we put the sectors into in terms of the recovery, and some sectors are actually having a relatively benign experience through the COVID crisis, but the ones I mentioned that are focused on people-to-people interactions and that have been hit by the social distancing, those are the ones with a much longer recovery profile. So again, that's going to be a year story rather than a couple of quarters story.
Right. Okay, thanks. Just come back to the Fed for a second, which recently broke with tradition around setting inflation expectations, opting to aim for an average. How is that likely to change the dynamic for access to credit?
Well, let me answer the inflation question first, and then the credit question. Well, central banks, not just the Fed, but central banks globally have been struggling to achieve their inflation objectives over the last decade since the global financial crisis. We just haven't been able to generate enough demand, enough spending power, and enough nominal growth. And the Fed came to the view that if their inflation target were a bit more symmetric, then perhaps we could get a little bit more inflation and nominal growth in the system, and you'd look at kind of the medium term, what they call the five-year swap for the medium term inflation expectations, and that's nudged up a bit. So the idea here is to reflate the economy a bit more in the recovery. In terms of credit, I mean, if we get growth and employment and profitable investment opportunities and everything else, then there really isn't any constraint right now to credit creation. Certainly in the bond market, with the Fed smoothing and rates low, that funding is available. The banks, of course, need to be a bit more careful with their balance sheets. But I think this is going to be more in the spirit of trying to get nominal growth and inflation up and get away from the zero bound and all these distortions we're getting with QE and zero or negative rates. I think that was really the objective there.
Given the states of valuations that we're seeing out there, I mean, what's your take on whether this even lower for longer environment can potentially create asset bubbles?
Yeah, it's hard to identify a bubble ex ante, but we know that QE is supposed to generate asset price increases, right? So, actually lowering interest rates, that's one of the channels through which the Fed and other central banks are trying to stimulate activity. If you lower rates, it's supposed to be easier to lend. Asset prices are supposed to go up. We're supposed to feel wealthier, spend more money, and the exchange rate's supposed to depreciate. Those are the channels through which monetary policy works. So the fact that asset prices are rising, that's part of the playbook. The question is whether it's excessive, and there's a question mark there. We obviously see on the real side, housing and real estate in certain hot markets, and we know what those are. They're the same ones most of the time. This is the New York, San Francisco, Seattle's, etc. The housing prices are quite elevated, and then the stock market overall looks pretty rich. Although if again you dig down to the sectors, and some of the sectors we mentioned earlier, airlines, entertainment, etc. Stocks, the market is actually pricing continued stress in those. So I would say asset prices are supposed to be part of the playbook as we recover, but again, we might want to drill down a level or two and go to that sectoral or regional story, because I think it lines up reasonably well so far.
Right. I have to ask this question is just to kind of get your sense of the buoyancy of equities given the current economic fundamentals.
Yeah, well, I'm not an equity strategist, so we'll put the huge caveat there. But again, if you take the sectoral view and not the macro view, if you look at the any of the big indices, the S&P 500 or the Russell or the total market or whatever, they're at or near all-time highs. But again, if you drill down and look by sectors, that's not a uniform result across the entire index, and you see a lot of variation, just as we see a lot of variation in macro and a lot of variation in credit. So the variations there, I'm not going to defend the level as something that's justified in economic terms, but I would just put a little caveat there that this is a time where we probably need to drill down a bit more than normal, and you can see the same theme of this uneven, unbalanced recovery in response to COVID coming through very clearly in the financial markets as well as the real economy.
Good. Just quickly, are you detecting any election overhang? We're just about 3 weeks or so out, either on consumer business spending or sentiment more broadly.
That's hard to tell. I would think the fiscal, we talked about fiscal uncertainty earlier, to the extent that uncertainty about the future of transfer payments from the government, if that causes households to spend less or firms to invest less or even slow down planned investment, that will have a measurable impact on growth. I don't think that's the big driver, but we can kind of say in a generic sense that markets don't like uncertainty, households don't like uncertainty, and that fiscal policy is really important. So I think the big swing variable, again, something we discussed a few minutes ago, is really fiscal policy, supporting the parts of the economy that are hit hard and, building the bridge to the recovery. So to the extent the politics goes into that, it's going to move the macro needle.
You mentioned Germany before, and so I'm just curious to compare the experiences. And since there hasn't been a playbook for a pandemic, what do you take away from comparing the U.S. experience and German experience and Chinese experience, for that matter, about what's the best way to go and what needs to be done?
Yeah, well, a big difference, if you just look at Germany or some of the other larger European countries, the big difference with the U.S., the obvious one, is the unemployment rate. The Eurozone unemployment rate is 7.9 or 8, so it's only gone up 60, 70 basis points since the start of the crisis. U.S. went from 3.5 to 14.7 down to 7.9. So the Europeans have adopted these flexible work schemes, which are really ways to, again, keep employers and employees connected through subsidies from the government, and I think that's a good approach to the extent that we skew these toward viable firms and they bridge to the recovery. I mentioned that statistic earlier. The amount of quote unquote work done in Europe, the reduction is about the same as the U.S. So you can see that the sort of the macro and the broad labor picture is the same, but the way it maps into unemployment is very different. I think the social contract is different in Europe. Angela Merkel talks about the social market economy, which is something we don't use here. That's a term we don't use here in the U.S. So that's the U.S. European comparison, even though the economies look like they're performing the same way. In China, as I said earlier, it's really it's the traditional playbook of state banks lending to state enterprises and local government financing of infrastructure. The Chinese do that well. That system is geared toward ramping up infrastructure spending and generating demand. They're struggling a bit. China's struggling a bit on the services side. And some of the social distancing restrictions, or I guess the legacy of those, is really crimping consumer expenditure. So I would say, Europe may have found the happy middle ground between aggressive fiscal response targeted toward workers and firms. And, the U.S. still could come out of this. But again, we've got to resort the labor market and the SME sector. And that's something Europe will have to do much less of as we build into this recovery.
Good. Thank you, Paul. Let me ask you one last question, and then we're going to take some questions from the audience. And that's really around risks. What are the risks you see to the scenario that you've laid out?
Okay, Gary, we've highlighted a couple of those already. Fiscal, I would say fiscal policy continuity is something that's important at this juncture. So if that is not happening, that's a risk to the the recovery, since it generates uncertainty. That one has a cousin, which is called premature fiscal austerity. One of the things that I think surprised some people is the amount of fiscal space governments actually had to borrow more money. We were worried before COVID that there was a lot of debt in the world and that fiscal space might be shrinking. Now we have even more debt. I think it was right to take on that debt, but as we recover and as we get back to pre-COVID levels of output, governments are going to have to signal, what's the path for debt? Is that sustainable? Central banks are going to have to say, what our balance sheet and our policy rate are going to look like. Does that make sense? Corporates have taken on debt, households, so that's a big worry as well. So all of those I would put as downside risks, and I would put the upside, maybe an upside on the vaccine. We've been very conservative with our vaccine assumption. We're taking that from the medical community. We're obviously not doctors, but every time we talk with our in-house medical experts, as well as listen to the experts out in the public sphere, the story seems to be getting a little bit better. Again, vaccine or vaccines, maybe by the end of this year, approved, and then distribution early next year. So that hopefully will turn out a little bit better than we had in our forecast. So maybe we can end there with a slightly positive risk.
Good. That's a good segue to questions from our audience. And the first one is from someone who's coming to us via LinkedIn. And that is, what are the longer term impacts of the significant fiscal stimulus in the US and globally to deal with the pandemic? At some point, doesn't the debt become due?
Yes, absolutely. At some point, the debt becomes due, and I think we should all be very mindful that we're in uncharted waters in terms of these debt to GDP ratios. But let's remember also that for every debtor, there's a creditor, and folks are willing to lend to the U.S. government at about 75 basis points for 10-year debt. That number in Germany and some European countries is actually negative. So at least for now, the markets are willing to finance the debt. As I said earlier, one of the risks as we come out of this is going to be, I think, a very proper focus on sustainable debt levels and fiscal paths, etc. But I think in the next couple of quarters, doing smart fiscal stimulus, again, cushioning the downturn, supporting the recovery is the right thing to do. But when the markets start focusing on fiscal sustainability, that will be a good thing. That means we're coming out of the COVID crisis and we're starting to get back to normal. And I think the focus will shift, which will be a good thing.
Right. This is a question that I think pertains to emerging markets, but not only. A question come in that how will the countries with economies relying essentially on tourism and cope with slow recovery overall of their economies?
Right. Well, that's we mentioned those buckets, those sectoral buckets a few minutes ago, and tourism is clearly in the bucket that's going to have the slowest recovery, along with entertainment and parts of food and beverage. So again, we've got a lot of variation across sectors, but anything that relates to person-to-person contact that gets impacted by social distancing is going to take a big hit. That's a company story as well as a country story, right? We can think about Southern Europe or the Caribbean or any of these countries that rely on tourism. If we have the assumption that we do get a vaccine and we can go back to at least normal social interaction at some point, and if these are viable businesses, that's an area where we should see more COVID-related spending than others. I think the key here is some of the countries, emerging markets, don't have the fiscal space to cushion those sectors, and we're unfortunately going to see more economic distress there.
Right. Thanks. We have another question, just basically calling out the fact that there are many sectors severely impacted by the pandemic, such as airlines, cruise ships, movie theaters, restaurants, etc. Many think that it will take 3 to 5 years for these sectors to return to pre-pandemic levels. And there's some debate as to whether or not some sectors will be permanently affected. So the question is, do you agree that there may be a permanent effect to some of those, or will they recover but just slightly longer than some other industries?
I absolutely agree with that. That's a very good comment. This is not a normal business cycle, right? This is a massive shock that has behavioral effects. So just off the top of my head, I can probably list a few things that will not be the same as they were before the COVID-19 crisis. One is commercial real estate. We already know that working from home isn't so bad in many sectors. Companies are reimagining their workspaces. There's a lot of weakness in the commercial real estate market in major cities. So that market's going to have to it's going to have to adjust. Maybe those those buildings get rezoned or repurposed or whatever. That's one shift. Health security is another shift. We're going to shorten global supply chains, and maybe a bit like Homeland Security after 9/11, we're going to have a lot more health security after COVID, and then maybe just some of the ways we interact. So I would say that's really the key medium-term issue. Which sectors are the ones that are going to go back to basically the pre-COVID structure, and which one of those are going to have very different look and feel? And again, the trick there for fiscal policy is you don't want to be throwing a lot of money at a sector that's going to be fundamentally different in 2022 and 2023, and that's a tough call for governments. But the structural change story is another one. We'll hopefully be focusing more on that in the future, but it's a good question.
Great. Paul, I think we're going to have to wrap it up for today. I do want to share that there will be a replay available on the Market Intelligence platform, on our external site, spglobal.com, Market Intelligence, and on LinkedIn and YouTube. I want to thank Paul for sharing his outlook and helping to unpack these developments. And thanks as well to you all for spending time with us today. We hope you'll join us again soon. Take care.